Our own Luke Kawa says buy the dip isn't dead. It's just getting stronger, in fact, at least for companies looking to capitalize on recent market drops. Here with more is Bloomberg cross-asset reporter Luke Kawa. Luke, always great to have you on. So as far as buybacks are concerned,
you got a boost. It's this nice, big, and getting bigger pillow under the market. Brian Reynolds over at Canaccord, he's been very strong in identifying how stock buybacks have helped prop up the market. He says even blowing out of the water his estimates for Q4, how many we're going to get, and it'll continue into this year.
How big are we talking, and how sustainable, just to go to your point about it, will continue?
So he sees, I believe, like 165 billion in Q4. And getting even stronger. He says, and I quote, our share repurchase line on our chart is going straight vertical in the wake of these earnings announcements.
Yeah.
So I don't know how sustainable it will be, but it's clear that these idiosyncratic market shocks that don't, deteriorate the macro backdrop aren't something that's going to eat into buybacks.
That good as the tax reform, that's all I can say.
Well, wasn't at one point the story that buybacks are being financed by super low interest rates and that there was a link there, and that in theory, if we keep seeing these interest rates rise, could that bite into buyback volume?
I think that's definitely been a part of the story. I think Binky Shada over at Deutsche Bank has done a pretty good job at dispelling that myth a little bit, saying it's not as much as we would have thought, but certainly a story, certainly an avenue through which you could see this pillow lose a bit of down feathers.
Is this kind of a negative sign for U.S. corporations in the sense that they have no other better place to put their money other than to buy back their shares at what by many measures are incredibly high valuations?
On the one hand, you have that. On the other hand, you could finance a startup like Uber and see your cash and burn up and at a very negative gross margin.
You don't have to have one or the other. I'm just saying, with investments.
You don't have to have one or the other, but if we're going to define the use of cash, I think shareholders would be a lot happier, getting something substantive versus these long shot plays.
And I mentioned the point in jest just now, but I do mean it. Tax reform, we were questioning to what extent buybacks would be part of the story here versus CapEx.
Like a lot.
Well, but we have to assume that there would be a bump, and going vertical perhaps is potentially a bigger bump than we were expecting, but this is part of the story.
For some companies, yes. For some, no. And I think when we look at the Russell 2000 index's persistent underperformance, even in the face of tax reform, one thing that comes up there is there are companies, really a lot of them will have to reduce leverage just to be able to do some interest deductibility. So that's one reason maybe I haven't caught up as much.